Soft atmospheric background music begins. The host speaks with a deep, calm, resonant voice. Picture this. You are staring at the chart. You see it. It's perfect. A massive displacement candle. It leaves behind a crystal clear fair value gap. It looks exactly like the textbook diagram you studied all weekend. You place your limit order. You calculate your risk. You smile, thinking this is the one. Price comes back down. It taps your entry. You're in. Then it keeps going. It doesn't react, it doesn't bounce, it slices through that gap like a hot knife through butter, hits your stop loss, and then cruelly reverses and goes exactly where you thought it would go. Why? Was the gap fake? Was the market rigged? No, you just tried to catch a falling knife because you ignored the narrative of the algorithm. Welcome back. Today, we are stripping away the noise. We are going to talk about why your technicals fail and how to filter for the high probability setups that professionals wait for. Before we begin, a reminder, I am not a financial advisor. There is no promise of profit here. Trading involves substantial risk. We are here to discuss mindset, process, and the psychology of execution using smart money concepts. Let me tell you a short story about a trader named Julian. Julian was a pattern hunter. He discovered the concept of the fair value gap, the FVG. To him, it was like finding a map to buried treasure. Every time price created an imbalance, Julian saw an opportunity. If the chart printed a gap, Julian placed a trade. He treated the market like a vending machine. Button push, money out. But by the end of the month, Julian wasn't rich. He was broken. He was taking 15 trades a day. He was buying in premium and selling in discount. He was trading during the lunch hour when the algorithm goes into accumulation. He knew the pattern, but he didn't know the context. Julian is most traders. Maybe Julian is you right now. You see, a fair value gap is not a signal. Listen to me closely. An FVG is not a signal to enter. It's a magnet. It's a point of interest. But a magnet can pull a car, or it can be crushed by a train. You need to know if you're the car or the train. The core teaching for today is about the filter. The difference between a retail trader using ICT concepts and a professional operator is the ability to say no. The algorithm isn't random. It delivers price efficiently based on time and price. If you are entering a trade solely because there is a gap, you are gambling. We need to install 3 layers of armor around your decision-making process. We call this the context triad: narrative, liquidity, and time. Let's start with narrative. This is the higher time frame alignment. Imagine a river flowing downstream with immense power. That is your daily or 4-hour bias. Now, imagine a small eddy or swirl going upstream near the bank. That is your 1-minute or 5-minute bullish FVG against a bearish daily trend. If you buy that FVG, you are swimming against the river. Sure, you might get a few strokes in, but eventually the current wins. Before you even look for a gap, you must ask, where is the higher time frame draw on liquidity? If the daily chart is reaching for a sell-side liquidity pool below, every bullish FVG on the 1-minute chart is a trap. It is a speed bump. The algorithm will smash through it to reach its destination. Stop trying to catch reversals. Align with the river. Second layer, liquidity. This is the algorithm secret that isn't really a secret. It's just ignored by impatient people. The market seeks liquidity. It needs to pair orders. For price to move up with energy, it usually needs to take out stops below first. This is the Judas swing, or the stop hunt. A high probability FVG usually forms after a liquidity sweep. If you see an FVG form, but there was no sweep of a previous high or low, ask yourself, where is the fuel? If the fuel hasn't been taken yet, you are likely the fuel. We want to see price rate a pool of liquidity, reject it violently, create a market structure shift with displacement, and then leave the gap. That gap has power. That gap has the backing of the composite operator. Slow down, breathe. I want you to visualize this. You are a sniper. You are lying in the grass. You see a target, an FVG, but the wind, the higher time frame trend, is blowing hard against you. Do you take the shot? No. You wait. You see another target, but the sun is in your eyes. It's outside the kill zone. Do you take the shot? No. You wait. This is the discipline required. You are not paid for the quantity of bullets you fire. You are paid for the accuracy of your execution. Third layer, time. The algorithm operates on a schedule. We talk about kill zones for a reason. New York AM session, London open. These are windows where volatility is injected. If you are trading an FVG at 1 p.m. New York time, you are flipping a coin. The volume is dying. The institutional order flow is paused. Why would you risk your hard-earned capital when the professional money is at lunch? Time is the x-axis of the chart. It is just as important as the price on the y-axis. If the time isn't right, the trade isn't real. So, how do we fix the Julian problem? We move from being a pattern trader to a context trader. We stop chasing every box and start hunting for the narrative. Here is the reality check. The market does not care about your diagonal trend line. It does not care that you really need to pay rent this month. It cares about efficiency. It returns to fair value to balance imbalances, but only to facilitate the move to the next liquidity pool. If you are buying in a premium market that wants to go lower, no FVG will save you. Let's talk about displacement. This is your confirmation. When price leaves a level, does it walk away or does it run? We want to see energetic candles, big bodies, small wicks. This indicates a heavy hand entering the market. If the FVG is created by lazy small candles, it's weak. It's likely to be filled and broken. We want to see the footprint of the giant. When the giant steps, the earth shakes. That is displacement. If you don't see the shake, don't take the trade. Now I want to take a moment for a mental reset. Close your eyes for a second if you can. Take a deep breath in through the nose, hold it, and release. Visualize your trading session tomorrow. You sit down, you open the chart, you see a setup that looks okay, but it's not perfect. It's in the middle of the range, it's against the trend. In the past, you would have clicked buy just to feel involved, but this time, you watch it. You sit on your hands, you feel the urge to click, and you let that urge pass like a cloud in the sky. You do nothing, you protect your capital. Later, you see the perfect alignment. Time is right. Liquidity swept. Displacement confirms. You execute without hesitation. Win or lose, you executed your plan. Open your eyes. That is the feeling of a professional. Here is your reset protocol for when you take a loss on a failed FVG. Because it will happen. Even high probability setups fail. That is the nature of probability. When you get stopped out, do not immediately look for a re-entry. That is your ego trying to get its money back. Step 1. Stand up. Physically leave the screen. Step 2. Ask, did I follow the context triad? Was the narrative clear? Did we sweep liquidity? Was I in a kill zone? If the answer is yes to all, then it was a good trade with a bad outcome. You accept it, you log it, you move on. If the answer is no, you journal the error. You write down, I lacked patience. You accept responsibility. You do not revenge trade. We often talk about the dealing range. You need to understand where you are in the current leg of price. Are you at the top 50% premium or the bottom 50% discount? If you are looking to buy and price is already in premium relative to the dealing range, you are paying retail prices. Smart money buys wholesale. Wait for the retracement deeper into discount. Wait for the optimal trade entry. Patience pays, impatience pays the broker. Many of you are looking for the holy grail indicator. You want a line that turns green when you should buy. But the holy grail is your risk management. It is your ability to survive the learning curve. If you risk 5% on a trade because you are sure it will work, you are already dead. You just haven't realized it yet. The market will eventually humble you. Stick to 1% or less. Respect the game. Respect your future self. Here is your challenge for tomorrow. I want you to go into your trading session with a one-bullet mindset. Imagine you have only one bullet in your sniper rifle for the entire day. If you miss, you go home hungry. You cannot fire at a maybe. You cannot fire at a looks kinda good. You can only fire at the absolute best, highest probability setup that aligns with your higher time frame bias. If that setup does not appear, you do not fire. You end the day flat, and you celebrate that discipline. A day with no trade and no loss is a victory over your impulses. Refine your eyes to see the story, not just the candles. Look for the trap before the move. Look for the stop hunt. Let the retail traders get induced early. Let them provide the liquidity for your entry. You are not here to be first. You are here to be right. You are here to be profitable. Remember, the chart is just a representation of human psychology and algorithmic efficiency. It is not a monster. It is not your friend. It is a puzzle, and you have the pieces. You just need the patience to put them together in the right order. Narrative, liquidity, time, execution. Stay focused. Stay disciplined. Don't let a bad day turn into a bad week. You are building a career, brick by brick. Trust the process. Even when the P&L isn't showing it yet, the results will follow the habits. I'll see you in the next session. Trade safe.